Hello, greetings, and welcome to Dividend Blasters. My name is Bob, and this is our 69th video. Our topic today, I'm a dividend investor, and I've added DGRO to my Core ETFs. So, if you recall 2 videos ago, I started this discussion specifically on ETFs, and recall, I'm primarily a stock investor for more than 30 years. However, I've been building my holdings in ETFs for the last 7 or 8 years. 2 videos ago, I said, hey, these are my primary core ETFs. And I mentioned SCHD, and I invested in that for dividend growth and income. I mentioned VOO. That's the Vanguard ETF. It gives me that broad market exposure to the S&P 500. I mentioned QQQ, and that is Invesco's ETF. It gives me that broad and deep technology exposure, and that tracks the NASDAQ 100. Those are the core that I have. And then last video, so those are the 3 core. Last video, I talked about 2 cash flow ETFs I have, both with JP Morgan, JEPI and JEPQ. JEPI is the JP Morgan Equity Premium Income ETF. It tracks against the S&P 500, and JEPQ, same thing, except that tracks against the NASDAQ 100. The difference here is that they are both covered call ETFs. So I'm getting a higher yield out of both of them. They are both monthly paying ETFs. And the dividends that I get are not just generated from the dividends of the holdings, they are also generated from covered call options that management team on both of those ETFs sells. And so they're able to generate higher dividends for me than other owners. So anyway, let me set that aside. Let me go back to the 3 core, okay? 3 core, as I mentioned, SCHD, VOO, and QQQ. This is number 4. This is number 4. I have smaller holdings here, but this is no less important. And I'm going to get to why I own DGRO. Okay, you might be asking, hey, Bob, why do you own another dividend growth income ETF? I'm going to get to that. First, a disclaimer, I'm not your financial advisor. Purpose of this video is for information, education. It reflects my own personal opinions, my research, excuse me, and my experience as an independent investor for more than 30 years. So please do your own research. Consult a financial advisor prior to making any major financial investment decisions. Also, I am on multiple platforms, and you can see that I am on X, Instagram, Facebook, and Threads. Excuse me. My profiles are all verified on those. That is me. Look for the blue check mark on all of those. You'll see some of my material on those platforms as well, but also you'll see some stuff that's different. So check us out. Follow us. We'd love to have you. I'm also providing my email address. It's drfinance999@gmail.com, and my handle here on YouTube, dr.finance6447. So before I talk about why I am invested in DGRO, let's just go over quickly the benefits of investing in an ETF. We covered this the last 2 videos. I'm getting that broad, wide diversification and lots of assets. I am spreading my risk. So as opposed to buying just one stock, when I buy a share of an ETF, I'm getting access to a basket of stocks, slices of them. So I'm spreading the risk. As opposed to maybe just buying one stock. Let's say I'm buying one stock that doesn't even pay a dividend. Totally dependent on the price appreciation. If I buy one stock that pays a dividend, then I'm only dependent on price appreciation and the dividends. Here, in a dividend paying ETF, I am spreading that risk and I am multiplying my access across lots of assets. Okay, and some of them are pretty big. You can buy an ETF that gives you access to the S&P 500, like VOO, as I mentioned. Or DGRO, I'm going to get to that in a little bit, or SCHD, which gives you access to 103 assets. So spreading the risk, broad exposure, also cost feasibility. I can buy access to lots of assets for a very cheap price. Okay. Um, and also think about the mobility and the tradability of a share of an ETF versus maybe a share of a mutual fund. This is much more efficient and effective. And the tax treatment of an ETF is superior as opposed to a mutual fund. All right, let's press on. So, DGRO. DGRO is managed by BlackRock. It's part of their iShares family of ETFs, and they are known as the iShares Core Dividend Growth ETF. Okay, they are there for dividend growth and dividend income. They track the Morningstar US Dividend Growth Index. So if you recall, SCHD tracks the US Dow Dividend 100 Index. This is the Morningstar US Dividend Growth Index. It's another index entirely. And I would say that the major takeaway here is that SCHD is invested in and tracks against 103 assets. This one, DGRO, tracks against 424 assets. They have 424 holdings. So here you're getting even a wider, broader exposure of stock than SCHD. The price is cheaper. It closed today at $58.40, and today is Tuesday, May 21st, 2024. We are up near the top of the 52-week range, which is 58.58. So we're getting very close, and we may go above it soon. The expense ratio is 0.08%. It's a little bit higher than SCHD's. And the expense ratio is basically telling you that for every $10,000 you invest, you'll pay about $8 in administrative fees to BlackRock. That's a very reasonable expense ratio. Anyway, the assets under management, about half of SCHD's, they have assets of about 27.6 billion. SCHD's is about 56 billion. Here is another major takeaway. Their price return for the last 10 years, 135%. It's actually better. It's actually better for the last 10 years than SCHD's. And if you look at the total return, last 10 years, almost 195%. Total return is price return and dividends reinvested. So it just goes to show you that compounding and a growing dividend really makes a difference. It's always better to drip if you can. The total return clearly outpaced the S&P 500 for the last 10 years by about 15 percentage points. This is a quarterly paying dividend ETF. The dividend yield, 2.28%. It's about 1 percentage point less than SCHD. The dividend growth rate for the last 3 years, 8.36%. It's about the same. And when I go to the next slide, I'm actually going to do a quick refresh of SCHD and then show them side by side so you can see them and how they compare. But I'm going to go through this first. Dividend growth streak is 9 years. SCHD's is 12. But this is a little bit younger. This ETF is about 3 years newer than SCHD. I already mentioned they are managed by BlackRock. The PADI, or the projected annual dividend income given a $10,000 investment, is going to approximate $227. This is going to be about $100 less than SCHD's. So what are the top 10 holdings? I'm just going to give you the top 10. You can research the rest because there's 424. But the top 10, Chevron, the big oil and gas company, Apple, we all know Apple, ExxonMobil. I'm providing you the weight in the portfolio of DGRO. The next one is Microsoft, and the next one is the bank JP Morgan Chase, then Johnson & Johnson, then the drug company AbbVie, and then the chip maker Broadcom. And we have Procter & Gamble. Everyone knows Procter & Gamble. They are a dividend king, as is Johnson & Johnson. And then we have the drug company Merck. Those are the top 10. These are all really good dividend-paying investments, and I own several of them. So when I see this, it gives me a comfortable feeling and a familiar feeling knowing that I own these. Now, let me just say this at the outset. I've been asked, hey, Bob, why are you owning individual stocks when you can just buy them all in an ETF? There are certain investments that I strongly believe in that I want to have a deeper level of ownership in. And owning stock versus an ETF allows me to scale that up in a very targeted and strategic fashion. And that's why I do that. I can scale up and I can scale down. The ETFs gives me, as I mentioned, that broader, wider exposure to assets. It allows me to spread the risk. The stocks give me the ability to scale up specific investments or scale down if I want. All right, that is DGRO. Let's go back to SCHD. As I've mentioned, they track the Dow Jones Dividend 100 Index. They closed today at 79.46, so they are about 80 cents off the very top of the 52-week range. They're both very close to the top. The market is kind of hot these days. The expense ratio, as I mentioned, is a little bit less. It's 0.06%. DGRO's is 0.08%. So for every $10,000 you invest, it's about $6. Administrative fees. Assets under management is about 56 billion, twice as much as DGRO's. Price return for the last 10 years, it's less. It's less than DGRO's, about 113%. Total return, it's closer, but still less, about 190%. DGRO's is around 194. Both are more than the S&P 500. So interestingly, one way to look at this is that the price return here on SCHD is much less, about 20 percentage points less than DGRO. But because of the superior dividend yield, they make up a lot of it. And the total return is only about 5% less. So they're making up a lot of that difference in price return in the superior dividend yield. Dividend growth rate is about the same. Dividend frequency, again, this is also a quarterly dividend paying stock. The dividend yield is about 1 percentage point higher, 3.33%. Dividend growth rate for the last 3 years, 8.56%. It's about the same, maybe 0.2% higher. Had a growing dividend for the last 12 years, longer than DGRO's, which was 9. But again, this is an older ETF. They're about 3 years older. So they're really on par. I mean, they're both very good record of continuously raising that dividend. They're managed by Charles Schwab. Projected annual income here, annual dividend income is $336. So it's about $100 more. That's not surprising. They have a higher yield. Top 10 holdings here, and you can see the weight. Number 1 is Texas Instruments, then Amgen, then Lockheed Martin, PepsiCo, Chevron again. You're going to see some overlap, but you're also going to see some differences. Pfizer, Coca-Cola, Cisco Systems, Verizon, and UPS. I own most of these individual stocks. Again, I like to see something that I am familiar with, comfortable with. I also like to see things that I don't own because it's going to give me new exposure, and especially if they are good assets. I'm looking for access to good companies, maybe that I don't own, for a decent price. And the price here is very decent for this ETF. So here they are side by side. You can see, and I would say major takeaways, DGRO is a little bit cheaper per share, has a higher expense ratio. Its assets are about 1/2 of SCHD's. SCHD's is bigger. DGRO has a better price return. The total return is almost the same. They make up for a good bit of it. SCHD does with their superior dividend yield, and so they're very close, but they're still a little bit less than DGRO. Both are superior to the S&P 500. Well, you may say, well, why not just invest in these instead of the S&P 500? Well, this does a different thing. Okay, when we invest, we're doing different things. Some things we're doing for dividend growth, some things we're doing for dividend income, some things we're doing for market exposure to diversify and spread our risk. That's what we do. Another key takeaway, I already mentioned that SCHD has a superior yield and has a superior projected annual dividend income. And you can see the top 10 holdings, the commonalities and the differences. A commonality is Chevron. is one thing. And I say that that's the one commonality in the top 10. As you go through the list, and you can go, deeper. You can look at the top 50. You can look at all of them. Go to Yahoo Finance, go to MarketBeat, go to the BlackRock site, and go to the SCHD or the Schwab site. You can get more information if you want to go that deep. I may actually do another video where I go deeper. Won't be today though. So there they are side by side. And I did find another tool that I wanted to share with you. It's called the ETF Research and Analysis site for serious investors. It's etfrc.com, and it allows you to compare two ETFs to see how they stack up. I like this tool. That way I don't have to go and do a deep dive in everything if I don't want to. I can go ahead and go to this website. I can type in DGRO and I can type in SCHD here on the first page of the site, and it'll tell me, wow, look at this. This tells me that there are 36 overlapping holdings, and that 8.7% of DGRO's holdings, which is over 400 holdings, are also in SCHD. And the 36% of SCHD's holdings, which are only 103, are also in DGRO. I think that's pretty interesting. That tells me that there is overlap, but there's lots of room where they're not overlapping. And it's going to give me that broader, wider exposure, which is what I'm looking for. What this tells me, and they do a calculation, is that by weight, there's an overlap between the two ETFs of about 20%. That's interesting. So, I don't want to see a high number. I'm not going to buy something that, says, well, this is a 85% overlap or 90% overlap with this SCHD, because I'm basically buying the same thing. Okay, maybe with just a different name. I want to see a lower overlap, but I want to see something that performs well, and DGRO does. That's what I like about this. And they have a breakout by sector. I think that this is pretty cool. You can see that DGRO is a little bit heavier in utilities and in technology within its portfolio, its weightings, versus SCHD. Okay, and SCHD might be a little heavier in energy and staples, consumer staples. Okay, and you can see the difference holding by holding. I think that this is pretty neat. You can freeze the screen, take a look at this. And, they go through the top 36 or all 36 of where the overlap is. And here they show the top 10, where DGRO is a little heavier. DGRO is heavier at Exxon Mobil and Apple and Microsoft and JP Morgan Chase. And they're a little lighter compared to SCHD and Texas Instruments and Pfizer, Verizon and Lockheed Martin. And, we did see some of that in the screenshot that I provided that showed the top 10 holdings. Well, here you go. And they show the percentage difference. And folks, that's it. I hope you found this to be enjoyable and informative. As I mentioned, I'm on other platforms. Check me out on Facebook, Instagram, X. I'm also here on YouTube. And I want to share with you some other resources of some of my colleagues who are friends of mine that I collaborate with, like Dividend Snowball. Dividend Snowball has a wonderful discussion group on Facebook. And I'm on there as well as on X. And we collaborate, we share notes and information. We learn from each other. And that's really the best way, is that they have that open exchange of ideas and best practices. And I urge you to check them out. Also, check out Dividends R Us. They are also on Facebook and X. A great group, lots of information, lots of good material shared. And, to be a successful dividend investor, you really need to stay on top of stuff daily. There are always dividend announcements coming out. This company's raising their dividend. This company is maintaining their dividend. This company is, hopefully not, but that does happen. We've seen that in the last year with some really big companies like 3M and Intel. This company is cutting their dividend. You want to know these things so you can act quickly. And then last but not least is another wonderful group, Saving and Investing for Beginners. This is a very big group on Facebook. Lots of information sharing, good discussion. Check them out. We collaborate a lot with them as well. So, folks, that's it. that is it. I hope you found this to be useful. Give this video a like, share the video with a friend, hit that notification bell so you know when the next video comes out and you don't miss it, and subscribe to our channel. Have a wonderful day. God bless.